Thank you for joining us today. The conversation is about the potential impact of the war in Ukraine on Africa and the markets. I'm joined today by Michael Potgieter. He is the Market Analyst for ETM Analytics and ICAP Africa. Michael, thank you so much for joining us. And just from your sense, what is the potential impact of the war in Ukraine on the financial markets in Africa?
Thanks for having me on, Tanya. I'd like to structure my response in two parts, namely the effect of the conflict on global asset markets, followed by implications for Africa and relevant industries. So I think the major theme of reference here is what happens when a country is fundamentally resilient and well-managed versus when a country is fundamentally fragile and prone to disruption. Countries like Germany, for example, they've got very low unemployment rates, very diverse production structures, whereas some of the African countries tend to be a lot more prone to disruption and a lot less developed. So in an environment of rising disruption, people tend to move capital out of African countries and into safer places, such as gold and places like Germany, rather. So the Russia-Ukraine conflict has had several effects. It's mostly been reflected in higher energy and commodity prices. This links to Russia's production of hydrocarbons, such as oil and gas. Russia accounts for roughly 10% of global oil production. And as a percentage of Russia's exports, oil and gas accounts for about 50%. So that's where the major effect has been. Now, given uncertainties about Russia's foreign relations, financial markets have priced in the potential that supply remains constrained, which of course has supported oil prices. They reached as high as $140 a barrel, roughly, and have averaged about $110 per barrel since. I mean, for comparison, during the worst of COVID, they were trading at around $20 a barrel. So we've had a massive ramp up in these prices, which will be affecting all input prices, transport prices, the cost of plastic, etc. In addition, as Ukraine is a prominent producer of wheat and grains, there's been a market supply squeeze there. Wheat prices in the US, for example, have reached the highest levels since the global financial crisis back in 2007, and could stay that way for a while. Some of the estimates have suggested that production of grains in Ukraine could be constrained by as much as 50%. Now, for Africa's markets, just to give you an idea, Somalia, for example, has 100% dependence on Russia and Ukraine for its grain. Egypt has about 80% dependence on both the countries. Major countries that are also very prone to a potential supply squeeze and have major trade linkages with these two countries include Sudan, Benin, Democratic Republic of the Congo, Tanzania. All of them have more than 50% of their imports coming, specifically the wheat imports, coming from Russia and Ukraine. So in that context, I would say that many of the countries that are, or companies that are seeded to outperform in this environment will be companies such as Sasol or Thungela Resources, which primarily focuses on coal. In addition to that, major farming output is going to be affected. To give you an idea of some of the financial market implications, the Egyptian pound, for instance, has been weakened around 15% this week. In addition, Ghana has also experienced very significant currency weakness. For these countries, this is a result of massive disruption. Foreign investors are becoming a little bit more judicious with where they put their money, and these countries are struggling to completely fund the expenses that are happening within the economy. It's also not all bloodshed. So a country like Angola, for example, has been receiving significant capital inflows, and that's due firstly to the fact that they export quite a lot of oil, and in addition due to the fact that they've been going through quite a lot of fiscal reform. So investors while they're pulling money away from the fragile and not very prudent countries who have massive imbalances or very underdeveloped capital structures, money is flowing to places that are resilient and have been direct beneficiaries of the major price moves in wheat and oil. Other major exporters of oil, for example, include Nigeria, Angola, Algeria, Libya, Congo, and Gabon. And that also significantly benefit from the higher oil exports. South Africa, for what it's worth, is also doing pretty well in this context. While we tend to import a lot of oil, there's been quite a rally in our own exports of commodities. So major exports like coal actually went a significant amount higher than oil in response to this. And just kind of breaks up the dynamic. There's some obvious losers, being countries like Egypt, and some obvious winners, being countries like Nigeria or Angola. But for Africa, major impacts are higher input prices, potentially some higher prices for commodity producers, and companies that are aligned with those two will be either benefiting or losing as a result.
Michael, thank you so much. That was very insightful. And as with any crisis, there's going to be knock-on effects, direct impacts, but also opportunities for those that are well positioned to take advantage of them. We really appreciate it. Thank you for that quick insight. And we are looking forward to seeing what the future may hold. And we really want to thank you for joining us today.
You're more than welcome. Thanks for having me, Tanya.